Hello again, fellow BeachBum traders. Thank you for joining us for our weekly trading game plan, part one for the trading week of May 30th through June 3rd. And the title of today's weekly trading game plan is Adapt or Die. We hope to show you how both that applies to both traders and companies, that now is the time to adapt or essentially go extinct. And you can see this quote from Charles Darwin that Sonia found I thought was great. It's not the strongest of the species that survives, nor the most intelligent. It is the one most adaptable to change. So that's what we're going to talk about, is how to adapt to any market, how to make money in any market, and also how companies are going to need to adapt to survive the upcoming recession that, in my humble opinion, is coming. So we'll get started. Again, here's our notes for the weekly trading game plan for this week for part one. And you can find the link to our Google Docs folder that contains all of our weekly trading game plan notes in the description box below. And good morning, Tanvir. Thank you for joining us. Do we have a fake out rally from your experience? Well, we'll take a look at that when we look at the indices and the futures, etc. So thank you again for joining us. Sound okay and everything? Please let me know. Give me a thumbs up or something in the chat if the sound and quality is okay. And we'll get started. So we'll start out. We'll look at how the markets ended up on Friday in FinViz. Start at the home page. Great. Thank you, Tanvir. So we can see the markets all, as Tanvir pointed out, had a rally on Friday. We've had a couple days of rally, and we'll look and see if that is in fact a fake out now. It was interesting. I put some stops in at the end of the day and kind of crashed, and so I expected a market on close to them to run it down before the holiday weekend, because just a reminder that Monday, May 30th is Memorial Day holiday. The markets are all closed. We'll see that in our schedule for next week as well. But I kind of thought we'd see a sell-off before a long holiday weekend. That's not atypical, particularly when people are leaving for their holidays. They sell, close their positions, and leave. So we see everything ran up, and it ran up towards the end of the day. However, we can still see some weakness under the covers. So the majority of stocks are still below their 50-day moving average and still below their 200-day moving average. So there's still quite a bit of weakness here, although we do see more new highs than lows and more advancers than decliners. And we'll see the histogram in Weibull in a few minutes as well. So some of the most recent news, you can read some of these articles, why people say the Dow bounced. World markets rally, treasuries fall on inflation data. And we'll take a look at the inflation data that came out. And then NASDAQ was one of the big winners for this week. We see crude ran up to 115. There's talks of crude going even higher due to some ECB. They're trying to sanction Russian oil even further. So we'll see where oil goes. Natural gas ran up over 9. I think it got to 940 something, and then it turned down, broke down below 9. Right now it's at 870. Again, there was talks of natural gas prices going up again. See gold's making a little bit of a rebound. Then we can see all the indices were up. We see the treasuries drop below 3%, not really inverted. So the yields were down, prices were up, and we'll see that again in the futures. So if we take a quick look at the indices, we'll SPY first. So we see this rally, this short-term rally for the past couple days. It essentially bounced off that support line, rallied up, crossed its 50-day moving average, but is still well below its 200-day moving average. So if we zoom out to the weekly, maybe we can see a better picture as to whether this is a a bear market rally, a bull rally in a bear market, or if this is a true breakout. So again, we see this little spike, this bottom, and then we see this large candle. Again, in the futures, it's kind of interesting. We'll see and check whether it made a real higher high. So, from this looks like a bear market rally where we saw before, we saw it bottom, make a big rally, and then essentially roll over because it didn't make a higher high. So if it fails to make a higher high, then we're continuing in a declining, descending bear market. So the jury's still out. This looks like a bull rally in a bear market right now. So it's not really a fake out. It's characteristics of a bear market that we're going to get these violent upswings and then a roll back over and continuing on the downtrend in the bear market. So again, as we pointed out last week, in a bear market, you want to sell the rips. So if you're sitting on a nice profit, protect your profits. If it continues up, you can move your stops up and continue to protect your profits. But in general, if something peaks out, you want to sell the rips in a bear market. Don't get stuck having it roll over and lose your money, lose your profits. So let's look at the Dow, DIA. So again, very similar, bottomed, spiked up. Again, that didn't even break its 50-day yet, so it's still below its moving averages. So again, it still looks like this is a rally in a bear market. The last peak failed to break the top. So again, so far these all look like they're bull rallies in a bear market. Some people will call these bull traps. So same thing with the Qs, nice rally off the bottom, but still well below its averages. Again, same thing, looks like a bull rally in a bear market. So all indications are we're still in a bear market. And this was a sharp, bull rally, great, sell the rip, take the profits, protect your profits. Same thing with the Russell. They all pretty much look the same. And we can't necessarily tell if the bottom's in. Again, if it fails to make a higher high, fails to continue to make higher lows, then we're still in a bear market. We're still in a descending market, which is fine. We've talked about this for a long time. We can make money in any kind of market, and that's the point of today is we adapt to it. We adapt to the bear market. We know how it behaves. We know how we can make money in the bear market, and therefore we don't die. Unfortunately, I'm not sure. I don't have data, but it appears that a lot of traders did not adapt and they're still trying to play like this is the 2020 2021 market that everything stocks just go up and they're dying, they're getting killed because we're not in that market anymore. We're not, this is a bear market, it's not a perma-bull market, so you have to adapt or you're going to get killed. So we're going to spend quite a bit of time looking at the VIX a little bit later. We had a request from Douglas PC to talk about trading volatility and look at some ROI for trading volatility. So that'll be a major topic of this week's strategies. But just to see, the VIX spiked up and then bottomed a little bit. We had another spike and then it trailed off. And part of this was the results of the FOMC meeting minutes that came out later this week. There weren't any real surprises. So people took that as, a bullish thing that kind of triggered the rally in the indices, and it caused the VIX to settle down some. So it's sitting in the 25, 26 area right now. And we'll see how we can make money on either direction in the VIX. So. Okay, so if we look at some of the group sectors that we're moving, best performers for the week. Okay, let's go to the groups tab. And you'll see I have these videos on how to use these various FinViz tabs. They're both in the notes document as well as in the description box below so you can get more information about how to use these various tabs in FinViz, etc. So we see pretty much Friday everything was green, technology led. Essentially, what was beaten down the most was what popped the most, and that again not atypical. In these kind of rallies, you're going to see those things that were beaten down the most are the ones that are going to pop the most on a rally. So, and then we saw the ones that were outperforming previously were the least positive. From the week, again, we saw strength in the technology consumer cyclical during that rally, but in general, the themes for the month for the bear has been energy, utilities, basic materials. Had another discussion question about healthcare and biotech. Not sure if we'll get into that right now, but you can see it's not doing well. And we can talk about in further detail what the reasons for that, but healthcare is not a positive theme right now from a 1 month standpoint, or if we go down for a 3 month standpoint. The positive sectors are energy, utilities, basic materials. The worst performing are technology, communication, consumer cyclical. So in this bear market right now, these are the ones you want to long, these are the ones you want to short, right? So that's where the longer term strength theme is. So if we look at the industries, see some energy again. Yesterday was a bit of an anomaly because of the big pop. So we saw a lot of the most beat down semiconductors was up. Real estate, we saw biotech did take a pop. So again, there's a big difference, and that's part of the adaptation that I want to talk about is, when we get these questions, should I buy biotech or should I buy? It really depends, in my opinion, what type of trading you want to do. If you're doing day trading, scalping, etc., very short-term trading, then you follow the momentum. You follow whatever's popping at the time, make your money. Scalping, etc. But if you're swing trading, you want to look at the longer-term theme. So, for the week, we could see energy, retail was up and down, etc. Again, energy, coal, basic materials, etc. And again, for swing trading, you really want to look at the longer term themes. Is there tailwinds or headwinds in the sector that you're trying to trade? Right now, the worst performers are technology, etc. Retail had a hard time in some cases, although the discount retail is starting to pick up. And we talked about Big Lots was one, although they had crummy earnings, so they initially got punished and then recovered. So we'll look at that in part 2 as a specific stock. So hopefully that all helps. We can see the industries forming well and where we want to target, short-term or long-term trades. So again, we want to adapt to whatever's happening at the time in the various sectors, target the sectors that are performing and fit our type of trading. So now let's look at the economic data from last week. So not much on Monday. Tuesday, we got PMI data, so manufacturing inflation type data. That was pretty much in line. All services was a little down, and then we got home sales was down. So we've been talking about the rollover in the housing market for some period of time, and here's now we're seeing evidence of that. Is that rollover in the housing market? So a while back we were looking at DRV. It ran away from us. We didn't get it. Maybe somebody did, and was able to profit and may still be profiting from that. So then Wednesday again, we got mortgage rates are up. Core durable good orders. Okay, so here's another interesting data points is we're seeing weakness in durable goods orders, and this is a potential sign of the coming recession. Is okay, people are ordering fewer long-term durable goods type of thing. So we're going to keep our eye on that. And then we got the Fed meeting minutes, and that was the important catalyst on Wednesday that triggered the rally into the end of the week. Is again nothing really unexpected. We expect 0.5 interest rate hikes both in June and July. Not much change there, although there was a quote that says they had a restrictive stance on monetary policy, and they may have to tighten above the neutral rate, which would imply that interest rates are going to go above the inflation rate. So depending on what the inflation rate is, is it 6%, 8%, 9%? They're saying they may have to go above that in interest rates to stem inflation, to kill inflation now, as we've been talking about. And okay, yep, good, Tanbeer. Yeah, we primarily swing trade too. It's very rare that we day trade. We can. It's just I'm not as nimble, but I know there's other peoples in our BeachBum trading community that focus on day trade. So I try to point that out, that there's a big difference when you say, is this good for this type of trading? Well, it depends. What type of trading are you trying to execute, and in which direction? Long or short. We'll talk about the adapting to that as well. So also the statement was made that the economic outlook still seems as highly uncertain. So the Fed doesn't really know if we're going to end up in a recession or not. Nobody really knows, although I think most people are predicting that we're more likely to end in recession than not at this point. And then so Thursday, we got jobless claims. Continuing was significantly higher than expected. And then we got PCE data, again, more inflationary type data, and we got GDP data. GDP wasn't bad, little negative. Okay, so this is revised Q1. So that says we have 1 quarter of negative GDP. So if we get 2 quarters of negative GDP, then technically, by definition, we are in a recession. So we have one. We'll find out end of June for the June quarter whether that was negative, but it appears that it is headed in that direction. Also, continuing jobs claim mean these people are having a harder time finding a new job. The initial was not bad. That means people aren't getting laid off heavily yet, but the people that are unemployed are having a harder time finding jobs. So again, that bodes for a slowdown in the economy. You hear the technology companies, they started by freezing hiring, and then now they're canceling open positions, and the next step would be layoffs. So I haven't heard a whole lot of layoffs yet, but I have heard freezing open positions, freezing hiring. So that's kind of the next step. Then Friday, we got and more PCE index data, trade balance data. Personal income was a little below expected. Personal spending was okay, but consumer sentiment was pretty negative and worse than expected. So it says, the consumer's not feeling real well about the economy. So that may feed into their spending, although this data says, okay, even though the consumers doesn't have a positive look on the economy, they're still spending like crazy, and we keep hearing that in travel, etc. That they're going to spend every dime they can get their hands on, and that doesn't bode well either, because that can lead to a crash and burn. Then we saw the Baker Hughes oil count, and this is interesting because I think this is the first decline that I've seen. It was increasing kind of in stealth mode, and now it actually went down. So that's not going to help alleviate oil prices anytime soon. So another news item I copied out was inflation rate slows to 6.3 because the PCE index shows that slowdown in inflation. So it says, okay, well, maybe we're starting to peak in inflation. So that was the gist of that article, and you can find a link to that article in the notes here and read that for yourself. So economic data for next week, and just a reminder, as this data comes out, I do put it in the notes now, so you can access it in that nice tabular form in the notes. And then I also put it in the Surf the Markets channel in our Discord. And there's a link in there to our Discord and that Surf the Markets channel. So you can get that real-time data in either place. I'm trying to figure out how to get this data in a nicer tabular color-coded form in Discord. So if anybody knows a way to paste that as a table, or I can get the embedded iframe HTML code from investing.com's economic calendar, but I haven't figured out how to paste that into Discord yet. So again, if anybody knows how to do that, if you let me know, that'll help save me some time trying to figure it out. So, but again, you can also find that data in the Surf the Markets channel in our Discord. So we look at the calendar for next week. And again, there's links in our Discord to this economic calendar, as well as in the links section of our homepage, which is beachbumtrading.com, bum without the U. So for next week, again, Monday's a holiday, so take it easy, enjoy your time off, enjoy your family, take a break. And then, okay, so Tuesday we see housing prices, so that will be interesting, although everything I hear says the prices aren't coming down, even though it is, they're headed for an oversupply. But right now, prices, they've got buyers already. So then we get some PMI data. Again, that'll tell us more about inflation. We got mortgages, more about housing, construction spending, and then we got ISM manufacturing. Again, this will tell us longer-term inflation. Is it really peaking and coming down? Then we got job openings. They're expecting a decrease in job openings, so it'll be interesting how that pans out. We've got several FOMC members continuing to talk, so if they say anything unexpected, that could trigger some volatility. And again, we're going to talk about, volatility is a great opportunity, in my opinion, in this kind of market. So, and on Thursday, we get jobless claim again and productivity data. So we'll see if that continues to trend in the direction that it has been, meaning continuing not meeting expectations, but initial not being bad. And then typical oil inventories, etc. And then Friday we get non-farm payrolls. So again, more job data. So the market's looking at inflation, risk of recession, and jobless, job data, unemployment data. And then particularly what the Fed says. If the Fed says something unexpected, then we can expect additional volatility. So for the earnings calendar for next week, I've got both the links to this graphic from Benzinga and to the investing.com calendar, and we'll look at the near-term one also in Weibull, so you can see this again, it's in the Surf the Markets channel in our Discord. There's a link to that there. You can see the graphical pretty picture view, or you can get the more detailed view in investing.com. Just by going to earnings calendar. Again, earnings matter, and again, you hear how the sympathy plays work when they get bad retail data from one retailer. It had initially knocked down all the retailers, including the discount stores, until the market kind of figured out there are categories of retailers. There's high-end, low-end, and mid-tier. And it's really, in my opinion, the mid-tier ones that are going to get hit the hardest by high inflation and potential recession. And just a note, Benzinga, if you're interested in Benzinga Pro, they're having a special sale. It was 40% off. Now they're offering 50% off. So if you use our affiliate link here in the notes with promo code MEM22, you can get 50% off now of Benzinga Pro. So we hope that helps. Okay, so let's look at the market screen in Weibull. Let me flip back over there to Anvir, and I'll look at You're asking PMI data coming out Tuesday or Wednesday. Okay. We've got some PMI on Tuesday, that's Chicago PMI, local. Wednesday, we've got ISM. So again, more manufacturing data. Manufacturing PMI for May on Wednesday. Cool. Okay, if we look at the market screen in Weibull, I'm using the online browser version of Weibull. And just a quick reminder, right now, for Weibull's 4th birthday, they're offering 6 free stocks. I don't know how long this is going to last, but right now, as the time of the recording of this video, you can get 6 free stocks right now with Weibull. And the first 2 are valued up to $300 each, and the subsequent 4 can be valued up to $3,000 each. So if you're not already using Weibull, it is our favorite trading platform that we use for most of our trading, and we highly recommend it. So if you're not using Weibull already, you can get those 6 free stocks with our affiliate link in the description box, on our homepage, on our YouTube channel, etc. So if we take a quick look at the advancers decliners from Friday, we see a lot more advancers. There's the rally. If we look at the inflows for a change, we see the NASDAQ actually finished with an inflow versus an outflow. That was the first time we've seen that on a weekly basis, at least on a Friday. And the NYSE had a little bit of an outflow. So it seems like a rotation of money from the NYSE to the NASDAQ. Again, in Weibull's Markets tab, you can also see a very near-term view of the earnings calendar. I find that very helpful. You can see which ones are before market, after market, in the near term. And then we'll look at the industries. It'll be interesting because most things were green on Friday, but there's things that are mixed. So you see biotech was mixed. It didn't participate fully in the rally on Friday. See some equipment. Okay, so REITs did well. Electronics was green. Construction materials, industrial, real estate, auto parts, and hardware software. And then if we zoom out a little bit, we're going to start seeing materials, things like that, energy, etc. Okay, if we look at the ETFs, so we don't see our typical ups on the Dow. S&P is gush. That's oil. That's leveraged on oil. SVIX, that's interesting because we're going to look at that in terms of volatility in a minute. Up on the Russell. Small cap bull. So the Russell's pointing up right now. Industries, pretty much mostly green. Energy, a little weakness. Financial, healthcare, a little weakness. Commodities, energy, copper, cotton, commodities, copper, cotton, inflation, commodities. Okay. Treasuries, 0 to 1 short-term treasuries. That's interesting. Blockchain, cryptocurrency's been very volatile. That's a whole nother topic to talk about. So, okay. So that's what we can see kind of from a market mix right now. Let's look at the futures. And again, I've got a detailed video on the futures, how to use this futures tab so you can dig into more detail. So again, this will give us a nice picture. Okay, so I like this picture. We can see, okay, the Dow futures has gone above its most recent high. So that's a positive indication that maybe this is the start of a turnaround. Same thing with the S&P. See, it broke the previous high. So again, from the future standpoint, which is a little different from the indexes, it looks like maybe this isn't a fake out. Maybe we're turning the corner into a rally. We need to continue to see, higher lows, higher highs. NASDAQ is a little more questionable. It tested the top. It may broke out a little bit, but it'd be nice to see a stronger rally. Same thing with Russell. It broke out nicely. So things are looking positive from the future standpoint. Again, we see the VIX is in decline. It's retracing to its mean. So I would expect back down to 20 unless something, triggers it to pop back up. And then possibly down to 16, but that would be very calm. So see oils around 115, gas still around 4. And then we see this run up in natural gas. It ran up over 9, and then it kind of rolled over. We'll talk about part 2. I tried to scalp the top of that. I was about a day early and a little too aggressive with my stops. But if other people caught that scalp trade, could turn a nice profit there. We see gold hopefully upturning. Same thing with silver. All the precious metals are kind of turning back up after having bottomed. Commodities are pretty stable right now. Lumber was declining. Looks like it had bottomed and is potentially swinging back up. But as we talked about on Wednesday, it's still relatively high. And then we see treasuries ran up. That was kind of interesting again. There's just kind of a buying frenzy in treasuries. The strength of the dollar, we'll see that the dollar weakened a little bit. So there was an inflow in the treasuries. So you can see the dollar has been weakening. That helps commodities, helps the treasuries, etc. But again, we expect this to roll over. But I haven't seen a great opportunity yet to short the price of the treasury, long the yield in the treasuries. So I hope that all helps. Okay, so now let's talk about our strategies real quickly. Again, the topic of today's game plan video is adapt or die. So again, we're trying to encourage traders to adapt to the current market conditions. What's moving? Are we in a bear market or a bull market? Our hypothesis has been since the beginning of the year that we're in a bear market, and therefore we want to trade accordingly. But if things change, we want to be able to quickly adapt to whatever the conditions of the market are so we can make money in any kind of market, right? So one of the ways we can quickly adapt, again, that I was asked about, how do we get ROI from VIX drops, or how do we trade volatility? And I'm in the process of doing a standalone video on this, and I was researching this so I could, at least address this question a little bit in this game plan. And we'll look at that very quickly about trading volatility. And I've added some links to some of the things I'm going to show you in the notes, and we'll take a quick look at that. But I think the trading volatility is a great way that, number one, you can make money in any kind of market, and also adapt very quickly. As the volatility increases, you can long volatility in a number of ways and make money. And then when volatility peaks and starts to subside, you can make money on the downside. And there's very significant amounts of money you can make, and this applies, shorter time frames, intraday, to days, weeks, etc. Generally not super long term, but these are great scalps, great day trades, but also great swings. And again, it's just a matter of, are you trying to trade the daily run up or run down in volatility, wherever it happens to be? You're trading the momentum, trying to scalp it when it peaks or troughs, or you're trying to swing it, in which case you want to find a stable support or bottom to long and a peak or top to short. So again, that's something I've answered in several of the questions. Is it depends. If you're looking to swing, I would wait for volatility to drop below 20 before I was going to long it. And typically we have been longing with UVXY. So again, I typically wait for it to drop below 20 to swing long on volatility on the VIX using UVXY. Similarly, I look at the most recent peak in the VIX, the most recent peak in in the VIX or in UVXY, which would be a bottom on SVXY, which is the short on volatility. So a peak in the VIX, again, this is the leveraged ETF to short volatility, or one of them, as I'll show you. And it bottoms when the VIX peaks. So find that. I put a standing order out on a good to cancel order out on that most recent bottom on SVXY. So then we can long it and short peak in the VIX. So again, I'll show you how I got some of these. So I did a search for the VIX in FinBiz, and it shows you the results. Here's the results from that search. You can click on that and go there. And then I brought that up in a screener. So I'll just show you how I did that real quick. Which indexes to short? Well, the indices, yeah, and there's a list of the long and short leveraged ETFs that you can use to long or short the various indices I think it's in our bear markets, how to trade a bear markets video, and it's also in a pinned comment in the ETFs channel in our Discord. So it'll tell you long or short any of the indices, what we use right now, like to long the Q's NASDAQ is TQQQ, to short the NASDAQ is SQQQ. So essentially, if you see and if you're day trading or you're swinging and you see the NASDAQ peaking and you want to short it, then we would short it with SQQQ. If you see it bottoming and turning up, then you want to long it, you'd use TQQQ. Again, which one's to long or short is going to depend on where are we at, what are the catalysts coming. Are we in a bear market? Again, in a bear market, we're selling the rips and we're shorting the peaks, right? So that's what we want to adapt to. And it looks like we had a rip. So if it peaks and rolls over and we want to short, let's say the NASDAQ, we could go long on SQQQ to short the NASDAQ. That's just an example. But again, you want to watch the behavior. So yeah, here's the pinned comment in the ETFs channel. You can see we have a bunch, which ones we have used to long or short the indices, treasuries, various global markets. So recently we've been talking about yin and yang, yin to long, yang to short the Chinese tech stocks, and also some of the commodities, although we have a much longer list nowadays, and we need a better way to update that. So I hope that helps. And welcome, Douglas, if that's you here. So thank you for joining us. We're just going to talk about your volatility trading. So I started talking about it again. What I did to find these, so I just did a search on the VIX in FinViz, and then it identified a bunch of things, and then I just right click, open that in another tab in FinViz, and that gives me the screener version. So then I can look, okay, so and then I filtered it down to ETFs. So here's the ETFs to use that you can use to trade the VIX. So then what I wanted to know is, okay, which ones are long, which ones are short. Some are obvious. It says, it's short, 1x short, 2x long, etc. And then they have different terms. Some are on the futures, some are on an index, etc. So there's different ways to long and short to trade volatility. And this is specifically the VIX. There are other types of volatility. And as I mentioned, I'm working on a whole standalone video on trading volatility, and this was helpful for part of the research. So what I did then is took all of those and put them in a new version of my comparison spreadsheet, so I could then mark them as to which ones are up or down, which ones are shorting the VIX, which ones are longing the VIX. And as I'll show you, we'll do one real quickly. This video's starting to run kind of long, so I want to cut it off soon. But I'll show you how I use a spreadsheet to then identify the risk reward profiles to pick the one to use that has the best ROI, which I believe is part of the question that Douglas was asking. So how I get that data, we're going to do VXZ because I ran out of time anyway before this video to finish this. So I'm going to bring VXZ up in FinViz. And the first thing I'm going to do is I'm going to grab the 52-week range, the high and low. And I also looked at the definition to see, okay, I can kind of tell this must be a long in the VIX, but we say, okay, well, what is it? It's a midterm futures index on the VIX, okay? And you could see, what do they say they're trading in, and that may be a consideration in selecting one of these. But right now I'm looking at the risk reward profile, the ROI, really strictly. So then I just go in there. I say, okay, that's 52-week low. That's a 52-week high. So that's the range for the year. That then calculates. Okay, so I already pasted that one in. That's fine. So then I want to see, okay, is there another range? I want to look at the ROI. So is there any support lines or resistance lines that are important? So right now we can see it's up here, 28 or 28.90, and there's this pivot point at 28. So that's a support line. So I'm going to say, okay, the nearest support to its current price is 28. I'm going to zoom out. Oh, come on. Okay, and I want to see where's the bottom on this guy. I'm going to zoom out one more. Go to the monthly. Okay, so then I want to find the bottom and the top. So it looks like the bottom, 1695. So this is how I do it. You can compare other ETFs, other stocks. Again, this is how I get the risk reward profile for any of this. So there's 1644. Okay, so it looks like 1644 is a bottom. And let's see what the top is. So the top is 4211. And I already know from looking at the daily that the resistance level is about that 52-week high. So then I can very quickly, okay, here's my downs. And this was an interesting exercise because, as I mentioned earlier, we typically use SVXY to short the VIX. And what I found out by putting all this data in is that SVIX may be in a more attractive risk reward profile for shorting the VIX. I want to do a little bit more research into what is that comprised with. It appears that that was a recent addition. It did not have the length of history that SVXY. So I want to see the composition of that in more detail. And again, I'll do that research in the trading volatility video in more depth. But based on that, it looks like SVIX may be a better ETF to use to short the VIX. Based on all of this data, it looks like UVXY is still the best ETF to use to long the VIX, both in a near term or short term standpoint. So this was the first attempt at creating a standalone spreadsheet like that just for volatility. It was still very manually intensive, so I'm looking at better ways to do these types of comparisons, but you can create a spreadsheet like this very easily. You can see what these risk rewards are, just dividing the low from the high for each category and getting a ratio. And again, that tells you what is the potential risk reward profile for that range. So I hope that helps. And again, I'll go into more detail hopefully soon on trading volatility. So again, I'm going to try to wrap up pretty quickly. This is kind of going long, but I want to stick with our theme, talking about adapting. So we talked about, traders, you need to adapt to the market conditions, the type of market, bull or bear, what's going on. Also important right now is the companies that you look at also need to adapt, or they're not going to survive an upcoming recession. And just some very quick points. And I'm going to go into more detail about recession proofing your portfolio, probably as a separate video as well. I'll probably cover these in more detail then. But just some quick points. Watch for companies that are reducing their cash burn, improving their productivity, pivoting to customers and markets that are going to be more recession proof, and pivoting from profitability versus growth at all costs. So companies are going to need to target becoming profitable to survive a recession and reduce their cash burn. And you'll hear venture capitalists are talking to startups about, reducing their cash burn to try to survive, because the venture capital is also drying up. So again, I'm going to do a separate video on recession proofing your portfolio. I'll talk about the definition of recession. We talked about it earlier. And then we had started this discussion earlier in the Don't Sell in May and Go Away video, so I won't repeat these items. We talked about government defense as a good recession proof, government contractors. A couple I wanted to add very quickly is look for companies with large war chests of cash and high free cash flow. If they have a good war chest of cash, they're more likely to be able to survive a recession. A good example of a company like this who also has look for companies with big share buybacks. If they're buying back shares, that probably means they've got plenty of cash and their stock price is down. They've been beaten down in the bear market, and there's great opportunity for them to reduce their share count and buy back shares at cheaper prices. So it reduces their share count. It's a way to reward their investors, etc. So again, a good example of this is Apple. Apple has high free cash flow. They have a lot of cash, and they're buying back a lot of shares, and their stock got beaten down. Now, there's some issues with their product sales, etc., but in terms of recession proofing, they do meet that criteria. So I hope this all helps. Please let me know questions in our Discord in the comments to this video. Again, we will continue these discussions about how to adapt to market conditions, changes in the market, etc. We'll further talk about what companies need to do to survive the recession, And we'll also talk more about recession proofing your portfolio. But please, again, post your questions in the comments to this video, in our Discord, etc., Facebook group. And we hope you like this. We hope you will subscribe to our video. Please visit our homepage. You can find links to a lot of these tools and resources on our homepage, beachbumtrading.com, bum without the U. And again, follow us on social media and let us know what you think of all this. How can we improve? How can we help you be successful in your trading? Again, let us know. We hope you like this. You all have a great day. Let me know if you have any other questions, comments, etc. Enjoy your Memorial Day holiday. Have a great holiday weekend. Hopefully, we'll see you for part 2. We're going to take all this data, and tomorrow at 9 a.m., we'll do a similar live stream, and we'll talk about our individual stocks that we're going to put on our watch list for next week based on all this input data and these strategies we talked about today. So thank you again for joining our stream, and have a great day. Bye.